The Middle Eastern market, in particular, is not necessarily just in the derivatives arena, but equities as well. There's a lot of split liquidity. Our colleague from Bahrain would probably agree with that. Across small little pockets of areas in the Middle East. One of the other issues that you face is the regulatory framework. The Middle East isn't, it falls into the same classifications everywhere else. There's a lot of demand for products, but essentially the regulatory structure is quite preventative. Now, in the derivatives arena, that's very different. On the equity side, it's, if I can just quickly mention the volume growth, although Dubai and the Middle East has seen a lot of issues recently, what with the Arab Spring and the fallout of the global economic crisis, the Dubai financial market, our peer exchange, has grown 131% year-on-year volume growth. That's necessity of the retail angle of the marketplace. Derivatives doesn't technically exist. In the kind of UAE, the Kuwaiti market, in particular Saudi Arabia. Why? Because it's against Sharia principles. Now, there is one exchange in Dubai that does trade derivatives. That's Dubai Gold and Commodity Exchange. But that is kind of like an SRO business model, where the regulatory framework allows for them to trade derivatives. Now, that's not to say that the landscape will change. There is very big moves at the minute, especially in the UAE, to change the framework for derivatives trading. Now what you're finding is the ESCA, which is the regulator, the Securities Commission of the Emirates, they are now looking at offering short selling. They're putting in frameworks for stock lending and borrowing on the single stock futures side on the equity. They're looking at market maker agreements, liquidity provision, all this kind of stuff. Why? Because they're looking to get an upgrade from frontier market to emerging market with the MSCI. That's a big push right now. Why? Because they will see considerable fund flow coming in from mandated fund managers on the equity side. So they want to be able to provide the framework that an international investor would see somewhere like in the US market or Europe for that matter. So at the moment, it's very much in its very early stages, true emerging market stuff. There's a lot of small industry providers that are looking to capitalize on that. In particular, the clearing side, firms like Clearstream and Euroclear, they're looking to provide industry backbones so you can actually trade products, whether they're cleared in the Middle Eastern market and offered in the UK, so on and so forth. So it's more on the back end where you're seeing a lot of the service providers capitalizing on developments in derivatives. But there is a lot of work right across the region to provide derivatives trading, whether that is on the single stock side or anything else for that matter.
What will be the launch of the different product types, starting with the single stocks? And then
yeah, well, no. The problem that you have, well, the problem, I wouldn't say it's a problem, it's probably an opportunity, to be honest with you. The UAE market is very retail driven, significantly retail driven. ADX, which is the Abu Dhabi Exchange, and DFM, which is the Dubai Financial Market, have over 500,000 retail users connected via NIN accounts to the underlying exchanges. It's hugely retail driven. So when you're talking about offering futures products in an equity space, bearing in mind the Middle Eastern markets are very new, they've only been around for about 10 years, really, in the truest sense. The products that we're offering at Nasdaq Dubai are single stock futures, but what we're more interested in is providing risk management solutions. At the moment, if you're trading equities, our colleague from Bahrain Bourse was probably trying to discuss this as well, is the fact that in the Middle East, if you trade equities, you've got no way of managing your risk. People see derivatives as this kind of big, or they're looking at the weapons of mass destruction and all this kind of stuff. And that is very true in the Middle East. It's a big educational push to prove to them that, look, if you're trading underlying stock, the best way to manage that risk is to go into a futures contract based on an index. Then the investor community come on board and they understand that instead of stock picking on an individual single stock, they can trade the index. Now, Patrick mentioned a very interesting point. Things like CFDs, contracts for difference, ETFs are very big. In particular, things like the Spider product in New York, gold, that's traded quite heavily by the private banking community in the Middle East. Because Dubai is the city of gold anyway, they have a natural lean towards that particular product grouping anyway. But things like CFDs are very interesting because the Middle Eastern market, they like to trade things like securities in the cash market. CFDs trade like cash because they're in the cash window, but you're allowed margining on it, which is a fantastic opportunity for them to free up a little bit more of their cash flow and then participate in the derivatives play.
And are the CFDs being offered by the exchanges, or are they being traded OTC?
At the minute, the majority of them are traded OTC, but at the exchanges level, our job at Nasdaq Dubai is to ensure that we can, one, launch these products, and two, train and educate the end user. It goes back to the simple thing: if you don't understand it, you don't trade it.
Exactly.
You have to go back and teach these guys how to use it, to give them leverage, risk management, and so on. Because the problem that you have in the exchanges markets in the Middle East, unlike Nasdaq Dubai, and I don't want to start giving you the sales presentation on Nasdaq Dubai, but they're very much equity driven. Mm-hmm. It's a one market opportunity. You don't get the opportunity to trade. So for example, if you trade derivatives with equities on one market, you can do your netting off of all of your positions. The central counterparty clearing model is very known and tested and everything else. So there's a lot of work to do in the background there.
And is there a CCP in each country?
We have one, yeah, we have one at Nasdaq Dubai. We have an international CSD model which links into Euroclear, but each country technically does have their own clearing model. The Qatar Exchange very recently has announced that they're doing their own clearing settlement depository system in order for it to be in an international level.
And what is the outlook from an international point of view? Are there international members joining, and will that help to develop the derivatives market?
Absolutely, yeah. See, again, Nasdaq Dubai, we bridge both retail and institutional. We're set up inside of the DIFC to allow for liquidity flow from all the international. So the who's who of financial institutions connect to us on the international level. We're also plugged into the retail market. So when it comes to the international guys, they're looking at opportunity. How do they tap into this retail community and flow of business? Which is not easy because the 500,000 retail guys or retail account holders, they're technically plugged into the broker level. So it's the broker then that interfaces with the exchange.
Right.
So you have to drill, the business model has to allow for things like white labeling on the ISV end to connect from the broker into the exchange. Now, the audience here are probably very aware of this kind of stuff, but in the Middle Eastern markets, there are very, very few of the local participants that have that style of model. Straight through processing, direct market access, from the end client to the exchange. Nasdaq, we have it, but on the local exchanges, it doesn't really exist. The other thing, opportunity-wise, is the market-making functionality, because you do need market makers in any market. In the derivatives business, especially when it's in its nascent period, you do need liquidity from a market maker. The local market makers want to be able to provide it, but the systems and technology front end, they don't generally have. So then there's an opportunity as well for trading these things.
I'd like Clive Furness to come up from Contango Markets, but while he's coming up, I'll ask him.
Sure.
So traditionally, the Middle Eastern markets have worked on a sort of pre-validation settlement model. How has that been customized for the derivatives space? Because it's a bit incongruous for a derivatives market to work on that model.
Well, yeah, on the derivatives model, it's pretty much the same principle. It's covered shorting at the end of the day. If you want to go short the market, and Nasdaq Dubai, again, we do offer shorting. You can short our markets. But as the original...
Short the underlying?
Underlying, yes. So if you have, let's say, for example, I as a market maker, if I offer my stock to be able to trade in someone else to short, I have to have that security lodged in the CSD in order for me to do that.
Right.
So it's technically covered shorting.
Okay. So, Clive, welcome to the panel.
Thank you.
I think you've been on a roadshow of conference events recently. Can we pick up some of the points that Patrick was referring to earlier? And basically, the differences essentially between the cash markets and the derivatives business as a defensible business for exchanges. And how difficult is it to take volume away from derivatives markets compared to, say, the cash markets?
I mean, I think it's nigh on impossible to take meaningful volume away from a long tail open interest on a derivatives contract. If you look at you just look at the plain difference between a cash market on a T+3 settlement cycle and a short-term interest rate contract that's got 10 years or so open interest, all the way out. It's you only have 3 days customer retention in the cash market. You've got 10 years on a lot more of that. And actually, the cost cost versus risk in terms of the leverage is, it's just minuscule. And yes, people do get bent out of shape about the cost, and people want to trade, at low cost levels because that's how their models work, particularly the HFTs. But realistically, an open interest on established futures exchanges is almost these days impossible to move.
What are the barriers to entry, say, on moving some of the index derivatives into new platforms?
Again, if it's established, it's a lot more difficult to do. The index products tend to be less far down the curve generally. So I think it's you've got more of a chance to move those. The new product, if you have new products, I think it's easier to put those into newer environments. So it's the innovation factor that Patrick was talking about earlier on, I think is a key issue for me, particularly for stock exchanges wanting to diversify. I don't see the Me Too being a strategy that's got any value whatsoever.
But then some of the attempts have been in the Me Too space. So where is the opportunity for innovation for a new entrant?
I think it sits around the data that the stock exchanges have and own. I mean, so to a certain extent, they're using that. They're building the indices, the MSCIs, the FTSEs, those sorts of things. What I don't think they're doing is looking at the deeper added value products that sit within those data sets, because they're not actually had to focus on that. It's been mass market, big index products, and I think there are a lot more targeted sector products that could be built. We're working with one stock exchange in particular at the moment to use their data to build an index using methodology we've created that allows for sector indices to be traded using very low volume electronically quoted stocks. So effectively, you're taking the bid offer spread, using that as part of the price formation for the underlying for the benchmark, and then offering the derivative on that. It allows you to have much more flexibility in the way that you offer, the products you offer and how you offer them to the marketplace.
Right. How does this sort of new entrant battle versus incumbent tie in with what you're doing in the Middle East area?
Well, it's quite interesting to hear, because obviously the mature market space where the large proportion of the audience are occupying, it's not something that we have. You're talking about things in the Middle East that I would classify as very much in the long term. We wouldn't necessarily even consider things like that right now. What we have to do is build there is a lot of demand for derivatives trading. Let's start at the very basics, build the open interest curve, start getting people to understand that it's not a one-trick pony, derivatives. It allows for a lot of opportunity right across the board, and then just build it there and after. So these kind of conversations, I think if I sat here 5 years from now, that's where we'll be talking these kind of discussions. And
I don't think we're talking, it's not impossible to get in. People have got into the derivatives markets and made successes of their entry to that space. I think it does involve a lot more thought. It's not just, hey, I want a derivatives market, let's go. I mean, I think one of the most innovative products I've seen in a long time was the plus markets medium-term interest rate product. It's it's an exceptionally brilliantly put together piece of work. The methodology behind the index, I think that where it sits between the short and the long-term curves, the ability to trade between those curves, particularly for the high frequency and the algorithmic traders who've got fantastic pinpoint pricing on both sides of that. There's a real opportunity within that. Is it whether I agree with the way it's being done through the IDBs is a different matter, but I think it's from a product perspective it's brilliant. And I think it's that type of innovation that we need to see, But as Plus have found out, and other people have found out as well, the infrastructure that you have to put in place to get into the derivatives market, it's not simply about the trading platform. The post-trade is a vital part of that. If you don't have connectivity to one of the three post-trade platforms in derivatives for the major banks, they'll never trade it. Mm-hmm. And that's big chunk of change.
So if Alasdair can come up, Alasdair Haynes, former CEO of Chi-X Europe, but while Alasdair's coming up, so does that mean the other area of opportunity in the derivative space is in terms of the alliances? So we saw the BRIC exchanges starting an alliance in terms of trading futures and single stock futures across the different Russia, India, etc.
I really think that's going to be one of the growth areas. I think everybody going down the same route of trying to deliver the same sorts of infrastructure is going to be, it's just lots of money being thrown down the drain. I see much more value in properly targeted alliances where the partners are focused on the same goals, maybe with different regional slants, but they're focused on the same goals and they share infrastructure, and that's better for the market and it's better for the people who innovate.
But what is different about this alliance? I mean, the 90s was all about alliances and they went nowhere, and then it went into an age of consolidation and mergers. Why will this alliance work when none of the alliances in the past really worked?
I think the pressures that the stock exchanges have been under in the last 3 to 4 years, as those cost figures showed, it shows very clearly that something has got to be done to diversify that away from that traditional revenue stream. Regardless of the technology aspects of it, if it stays where it is, that's a downward spiral. And it's not a healthy place to be. There is a business necessity to move out of that and diversify into something that can create longer-term defensible revenue streams.
Alasdair, welcome.
Thank you.
Congratulations on getting the merger through with BAT, and also for getting plus 20% market share in equities. In terms of the derivatives, I know Chi-X was thinking about going into the derivatives space. What do you see as the possibility for MTFs to actually crack the derivatives game?
Well, I mean, having heard Clive now say it's nigh on impossible to break in, I think I would agree with that. It is going to be extremely difficult, but I think it's not impossible. I think when we set up ITG back in 1996, people were telling me that I was completely and utterly mad to bring in crossing networks. Now a crossing network is something that everybody has. And I think the same thing if you asked people 5 years ago about MTFs, they would have said there's no way MTFs can actually get into the market and take market share away. And today, I'm sure many people think that derivatives is going to be impossible, but that won't be the case. Somebody will succeed. And it really comes down to three things that I think you put up this morning on your slide, which was innovation, which you talked about here, customer service, and actual execution quality. And actually, I wouldn't just do execution quality, it's just about quality. And this comes down to technology, how you build that technology, and how you approach the market. You've got to remember, and I think, frankly, I loved Patrick's presentation this morning, but I think I need to take Prozac pills now, because there's a lot of very, very depressing stuff in there if I was an exchange, which is, if I was a national exchange and you want to go to, you've now got to go around the world. Well, if I'm an African exchange, I don't have a mandate to go around the world. So the only other thing I can do is move into the derivatives market. And if the derivatives market is nigh on impossible to get into, then Prozac is probably the answer. So what you need to do here is tackle the differences. And the differences here between cash are phenomenal. You've talked about settlement, how you actually approach the CCP. These are short-dated instruments. These are not the same as cash. They're not fungible. And what's going to happen here is to be very creative. And I think the key comes down to, and I think I think an expert in equity businesses, not necessarily fixed income or FX, but in the equities space here, the index products are absolutely the way forward. I think what BAT's Chi-X was trying to do here by creating deals to go into the index space is innovative. It's creative. You look at America, there are many different indices to trade. If you look in Europe, there's actually only one equity index that has any liquidity that people trade. And the world needs more than that. And the world will have more than that.
So there's a couple of points there. On the index products, how possible is it to license or get a license for the underlying benchmark index, or do you have to create a replica?
Well, the answer to that is very easy, because the answer is no. Had the Deutsche Börse NYSE deal gone through,
Yeah, exactly.
I think we would have seen a different story. But as we stand today, and you know, turkeys don't vote for Christmas. It's a very simple thing. If I'm an exchange, I'm running an exchange, why on earth would I sell the golden goose? This makes money for exchanges. We looked at the slides this morning where revenue streams are going down. If I owned a product, why on earth would I give it away to somebody else? So that's not going to happen voluntarily. It may happen involuntarily through some form of regulation if that's what people want, but I don't see that happening in the short term. I think this is something where you've got to go and compete, so therefore you've got to have new licenses and new products coming in.
So Craig, how easy is it to create these new licenses and new products or
I think
replicas?
it's a very interesting point, because we in the emerging markets, we actually go after the FTSE products and the MSCI products and the S&P and the spiders and all this kind of stuff. Why? Because they're already being traded in the Middle Eastern markets. And it's all about licensing at the end of the day. You get a license agreement with the underlying provider and you get them listed, as long as you have the CCP and the CSD backbone to allow for clearing and settlement and depository in our environment. It's fine. The one thing that you have to bear in mind about the Middle Eastern markets in particular and emerging markets is they're learning from the lessons from international established exchanges, and they're building business models which are multi-asset from day one, right? So they're allowing for things like derivatives. They get a license for derivatives and cash markets on the first day, and then they also get the opportunity to build a clearing engine. Even if it's not done in-house, they may buy that infrastructure in. But you look at Qatar, you look at Bahrain, the Bahrain Financial Exchange, you look at Nasdaq Dubai, we have a multi-asset trading environment. So we're not looking to buy in liquidity or buy in contracts, we can develop them ourselves. Indexes are definitely the way forward, because that just gives so much different. Single stock futures, I'm not a big fan of single stock futures in the emerging space. But in the index space, they just work so well.
So on the index products, I mean, for example, you announced that you were going to create a deal with Russell indices. How is that going to roll out and compete with the other benchmark indices?
Well, I'm for all sorts of legal reasons, obviously I can't go and talk about days with Chi-X and how I feel that will go forward. But I think on the index point is, you know, there is an innovative product, and I'm sure it'll be the one of many different innovative products. The problem I have, and what Craig said, which is very interesting, is we'll just go out, we talk to FTSE, we talk to other people, and we go and license them. Well, on one of the slides this morning was about equality. I can tell you, having run an MTF, that the conversations that I had with a number of exchanges about licensing products were some of the shortest telephone calls I've ever made. You know, if the whole conversation from nice to see you to goodbye, it would have lasted about 30 seconds. So, you know, this isn't equal. And again, I understand why. Why on earth would somebody want to give me the product to go and compete with them and have their lunch?
So therefore, we're back. So there are two routes to market then. One is that we crack the barriers, the fungibility issue, the CCP issues, the settlement issues, etc. The other route is innovation. So Clive, I mean, building on your experience in both the equity space and the commodity space, for example, is there any possibility to create some innovative derivative products, linking different asset classes?
Absolutely. I mean, if you look at the equity markets, particularly with a commodity bias, and something that we've been working on for a while, and it's really still only early stage, but if you take a lot of the stocks that have a commodity market price element to them, you can actually, there is a way of deltaing out the commodity market risk of each of those stocks. So actually what you could have is a commodity market risk product that is a pure equity. Right. You're just deltaing in or out, so you're actually either exposing yourself to the management or you're exposing yourself to the market risk, depending on which side of that trade you want to be.
And could a new entrant do that, say for example, on commodity stocks listed on the LSE?
Absolutely.
And there's no licensing issues?
Well, no, because it's about, you know, you can be created out in the bank market. Equally, the exchange can create that itself. I mean, one of the things when I heard about the potential London Canada merger was the strength that would have created in the mining sector was unbelievable.
Yes.
You know, that would have made the London Metal Exchange an absolute no-brainer.
Yes.
You know, that immediately starts taking you down paths that, you know, for whatever reason aren't now going to happen. But you know, the fact is that if you take the you know, that strength in mining, and it's still there probably in London and in Toronto too, but you know, if you take that down its logical path, you can create these products, and it's not just metals, it's an awful lot of other things too.
Okay. Are there any questions from the audience on the derivatives matters? Given there are a number of exchanges in the audience looking at setting up derivatives exchanges. Yes, no. Okay, one other point maybe, Alasdair, on the other side. So one option is to innovate, the other option is to try and unbundle all the regulatory barriers. How is that going to happen in the absence of NYSE Deutsche Börse merger?
Well, I think the NYSE Deutsche Börse lack of merger was sort of a watershed moment in our industry. Ironically, I wonder whether the regulators have actually done us a disfavour by preventing it. And the reason I say that is that clearly, if you ask any lawyer, it was anti-competitive. And I think most people felt that giving one exchange the ability to have a really large control over the derivatives market space, no matter how strong their arguments were, and they were very good arguments, did make something which was probably anti-competitive, and certainly proven to be the case. However, it would be an awful lot easier to compete against a monopoly than actually a duopoly. And I think at the end you've got to remember, why have MTF succeeded in getting market share in cash business? It's because the customers ultimately wanted it to happen. And that is the key to all of this. If the customer, ultimately the end user, wants to have an alternative derivative market because they don't like the way the markets operate today, then it will succeed. And markets have changed in 5 years. You know, I'll be very rude about the people who are sitting in this room and are here today, but 5 years ago, most people ran their exchanges as effective monopolies. They didn't necessarily listen to the customer. They didn't necessarily look at trying to reduce cost, and they kept on raising margins. And the industry got fed up with it, and it fought back through the MTF space. That is not the case today. Exchanges are way more business orientated. They spend a lot more time listening to their customers. They're very creative and very innovative, and that makes it tougher to compete.
I mean, Craig mentioned something earlier on, which was about, you know, putting the cash and the derivative and everything into the pot in one place. I think there is a real battle to be fought on capital efficiency. You know, with costs going up, regulatory capital requirements going up, and significantly in many cases. I think there's a large argument to say that you can put almost a quasi-prime brokerage in place at the clearing level, as long as you've got the multiple asset environment. And these vertical silos are, you know, they're a problem. They are a problem for that. You know, whilst many exchanges will say, oh, we have a multiple asset class environment. Yeah, you only have it for what you've got. You don't have it for everything else. So the long and the short end of the curve aren't together in Europe. And I think, you know, you're right. I think the regulator has done us a huge disservice by not having the curve together. And interoperability, forget it. It's not going to happen. Not at clearinghouses, not in any hurry.
But
so
it won't voluntarily happen. It's whether actually MiFID II and whether EMIR actually forces in some way to open up the clearinghouses. There's no secret sauce here. Cash equity business is all about data. That's where revenue's made. Derivatives markets is all about clearing. I mean, that's, you know, if that is the secret sauce, we've let it out. Everyone knows it. So, you know, at the end, if you want derivatives to work and the customer insists that it does, then you've got to have some form of interoperability, or there's got to be a lot of different products out there.
So one final question, what's the timing outlook? When will competition exist in the derivatives markets in Europe or in the Middle East, or each of you?
Well, I think, you know, what you had, I guess I'm coming from a different angle, as I said, from the very beginning. I come from a market that's quite restricted. It's not yet open, but it will open. If you look at the Tadawul, if you look at the minute, you've got 3 exchanges in the UAE alone, right? We've merged with the DFM. There's talk about all 3 merging together. So you have this one central environment for accessibility. There is talk, again, Mark Mobius made the statement last week where he was saying, you know, maybe the Tadawul and the Kuwait and the Qatari market all join together. So that's where I see those as opportunities, not trying to scrap around in the mature markets for derivatives or the cash model. It's there where it's at. And it's where I think the major internationals should, as the slide showed from Patrick, you know, all these tie-ups that are happening in the emerging space, not in the mature market.
So in Europe?
I mean, I absolutely agree with Craig. I think trying to attack the incumbents is a waste of time. It's already beginning to happen in terms of looking for new products. I absolutely agree that the index space is going to be key, but it's innovation in that space and the sharing of infrastructure. I think if we can find, you know, cheap, effective, accessible infrastructure for a broad range of participants, then I think there's a reason for participants to look at alternative venues. I think just more monoliths. It's you know, we're just creating more of the same problems in terms of cost, in terms of access that we've had up to now. And access is going to be part of this. You know, innovation. You know, the clearinghouse innovation is also going to be part of it. I mean, what Chi-X did with the equity-linked CFDs, I thought was a brilliant piece of work. You know, it was just a really thoughtful way of getting around a big problem to offer a product to the marketplace. I think the CFD markets are probably going to be a real opportunity too, but you know, this is about keeping it simple, keeping it effective, and making it accessible.
Alasdair, do you think competition will be here in the next couple of years?
I do, but I think it's dependent on how the large players today react, and I think it's about the model that actually the newcomers who come into this space, what they create, and by that, anything that is public, you know, demutualized, has, as I think it was pointed out this morning, a need for its shareholders to raise margins. And when you have a business that is being forced by shareholders to raise margin or keep margin up, there's always an opportunity for a newcomer to come in to lower margins in a more effective way. So I think the timing is really dependent upon how people react today. The opportunity is there because if you talk to the end user, they are dissatisfied with the prices that they pay. But we do have to conquer the issue of settlement, and how we actually get that going is probably going to be a regulatory answer.
Exactly. Okay, unless there's only one final question from the audience. Is anyone? Okay. Thank you very much for joining.